Hi everyone, it's Kevin Davey. Welcome to 4 Ways to Improve Your Trading Performance. Before we get started, I just want to make sure you can hear my microphone. So if you can, just type a Y in the question box, just so I know you guys are hearing me. And perfect. Thanks, Albert, Mark. All right. So hey, let's get started here. Okay. So today I'm going to talk to you about some proven ways, actually 4 proven ways to improve your trading performance. They're pretty powerful tools you can use in your own trading. Most of you probably are algo traders, so you're making rules and testing, and this will definitely help you. But even if you're a discretionary trader, hey, this is also going to help you. So they're, like I said, they're proven, and I'll explain everything. It's pretty cool. So if you're a live viewer, which you are, and then also the people who are absent who couldn't make it, who signed up couldn't make it, and the people who are locked out because the room only holds 100, you're going to get a copy of this whole presentation. It's going to have the Q&A that's at the end, an autographed book giveaway, which I'm going to do live, and then a special surprise that only people who register have. And so the YouTube people, anybody who views this on YouTube, will be a little bit sad because you won't get those things. So if you're interested and you're listening to this on YouTube, sign up on my website. You get a free book on trading entries and exits, and you also get invited to these free live events. So you can get all those other benefits. So it's pretty cool. So it looks like people are still piling in. So before we really get started, first, just wanted to mention the last time, I think it was last week we met, somebody left a comment on YouTube and it said, must you tell us about the lake house in Ohio every time? It's not Ibiza. Chill. Okay, well, I guess I don't even realize I'm doing it. I don't remember ever talking about where I live or showing pictures. Or, well, maybe once or twice, whoops. So, but anyways, thanks for indulging me in that. I had to Google where Ibiza was because I've never been there, never really even heard of it, but I guess it's off the coast of Spain. And so today I'll show you a picture of that instead of where I'm at. And this is pretty cool. I think I would like to do that. So with that, we have our first poll of the day. And so I'm just curious of who's been to Ohio, who's been to Ibiza, if I'm pronouncing it right, who's been to both, and who's been to neither. So just kind of get you guys warmed up. We're going to have some other questions that are trading related, but these aren't. So okay, we'll give a couple more seconds to let people vote, and I'll show you the answers. So. Okay, so it looks like Ohio and Ibiza are running about the same. I don't think the weather in Ohio is as good as what you got there. Very few of you have been to both, and most of us haven't been to either. So just kind of interesting. Okay, so let's get back to some real stuff here. I guess I forgot. I am showing one picture, and this is the coyote that has been hanging out in springtime on my back cliff. And so I got to show him every once in a while or he gets mad. So I don't want to do that. But all joking aside, we're going to talk about some serious stuff with trading, but just kind of wanted to lighten the mood. I mean, trading, as you know, is lonely. You're usually doing it by yourself, and it's kind of real serious. And hey, sometimes we got to lighten up a little bit and just kind of take it easy, right? So don't make Lake Coyote mad. All right, but if you have comments on videos, go to my YouTube channel. I've got, I think 42 videos, all kinds of trading videos. Feel free to leave comments. And if you subscribe, when I get to 5,000 subscribers, which isn't that many, but it is for trading, I'm actually going to give away a free algo system to everybody, and I'll do that in a video. So, you know, check out my YouTube channel. You can just type in Kevin Davey in YouTube and it'll come up. Subscribe, and you know, you'll be notified when I do that giveaway when I hit 5,000. All right, so now we get to the serious stuff. So now I gotta change my voice and be real serious. Is that my serious voice? I don't know. I'm a little goofy today, so you have to excuse me. Don't trade with money you can't afford to lose. Past performance is not indicative of future results. Hypothetical results were developed with the benefit of hindsight, so watch out. And, you know, futures trading has large rewards potentially, but also large risk. And actually, you should focus more on the risk than you do on the rewards. Okay, with that, how many of you have experienced this? I'm going to have a poll when I show you what's happened, but you create a back test and it looks great, you know, and it's everything to the left of the blue rectangle. And then, of course, you go live and it does something like this. So I'm curious how many people have actually experienced that. So just yes or no, or yes multiple times, yes once, or no never. Have you ever experienced that? And I can tell you my answer is yes multiple times. So not ashamed to admit it, maybe a little embarrassed to admit it, but hey, this is how it is. So let's close it and I'll show you the results. 72%, so 3 out of 4 of you. This happens multiple times. This is what happens when you back test. 8% has never happened to you that you've done a back test and it's never done poorly in real time. So if you're one of those 8%, send me an email and let's talk about what you're doing, because I want to know. Because like I said, I make mistakes and I have this happen even now sometimes still with strategies, and I know I do things correctly. So maybe we should talk. Okay, so most of us agree. We have this happen multiple times, okay? Like I said, don't feel bad, because this is an elusive thing, having your real-time performance look like your back test. It doesn't happen that often. It's very hard. A lot of times, this one isn't even that bad relatively. Yeah, it went down, but then it kind of went sideways. We've probably all had strategies that just collapse, that just whoop, go way down. That kind of thing happens. To keep going in a straight line is tough, and that's one of the things that, you know, by improving your performance, you're going to get more of those kind of strategies. So it's kind of what we're looking at. So people who've attended my workshop have created 300 strategies to date that have worked live for a 6-month test. So they haven't fallen apart like you just showed. They've actually passed a 6-month live test where they've performed, you know, pretty well compared to the back test. And, you know, that's my award-winning workshop. The neat thing is we have some secrets that I'm going to share with you that I've learned from the students, from looking at their strategies, from analyzing hundreds of strategies. Obviously, if there's 300 that have passed, there have been quite a few that haven't passed. So I've been able to kind of look at all that data and extract ways to improve our performance. And that's what we're going to talk about today. So going into the secrets, the first one is called INOPT, and I'm going to explain all these, obviously. Second one's good, but third one's baby it, and the fourth one is entry E. So those are just little teaser titles for what I'm going to be talking about. So let's talk about INOPT, okay? What that stands for is intelligent optimization. And it's something most experienced traders understand. You just can't optimize your way to success. And if that's something you're doing, stop it. Just stop. Don't do it. Most experienced traders realize that optimization can be really bad. It can be worse than doing no optimization at all, right? But when you do it right, when you do it intelligently, it can be really pretty powerful, okay? And one of the reasons is price data is pretty noisy, okay? I think we'd all agree on that. You know, it's not just a nice smooth trend from point A to point B. It chops around, it goes up and down, and even within a bar, these are minute bars you're looking at, there's quite a bit of wiggle room in here. You know, it's a point or two just on a 1 minute bar. So there's not clear trends all the time. A lot of times there's a lot of noise in the signal. And what happens is when you try to optimize, especially if you over optimize, all you're doing is you're fitting the noise, okay? So think of it like this, where you're putting just a moving average on that, and you try all the different moving averages until you find one that is a best fit. And I don't know if this particular one's a best fit, it probably isn't, but you're going for a best fit, but you're fitting to data that's noisy, and you know it's noisy because it's bouncing around. So what possibly could you gain by optimizing noise? And you know, the simple fact is you can't really do it, okay? You optimize noise, and the noise in the future is going to be different, and your results are going to suffer. So what we do is we optimize, but we do it intelligently, okay? And what is that? Well, that's the whole trick of this, right? This first performance improver. You balance the rules you have in your strategy. You balance the number of iterations. You balance the number of inputs. You know, the number of things you're optimizing. You got to balance that with future performance, because I can put in a ton of rules, a ton of iterations, a ton of inputs, and get great back tests, but my future performance will just suffer. And that's where most people get hung up. They think more iterations are better. You know, I always love, I love hearing it, but I feel sorry for the people. I hear them on trading forums where they say, you know, hey, can you give me a recommendation for a new computer? My computer, it takes all weekend to run my 5 million iterations. And I'm like, what? Oh man, 5 million, what are you doing? And then, you know, people will chime in, oh, use genetic, that will make it go faster. Oh, you know, put some of the, run the code and do it with a graphics card and it will do it faster. And I'm like, oh, they're just doing things wrong. It's bad. It's really bad when you start doing that kind of thing. So you got to balance that. And that's the whole trick. More is not better with these things on the left. More inputs is not better. More rules is not better. And more iterations are not better. Less is more. Okay? So here's what I mean by that. I've taken over 1,000 strategies, and probably a few thousand, of my strategies, my own personal strategies, my student strategies, and I've been able to boil it down to some easy conclusions that you can use in your own trading, right? You can start using these today. Build strategies with less than 4 optimized inputs. So if you have more than 4 variables that you're trying to optimize, it might be too many. You want the same rules long and short. You don't want a separate rule for entry and then exit. You know, that just makes what's called degrees of freedom, makes more degrees of freedom, makes it more likely that you're going to curve fit. Okay, so I like to keep everything symmetric. Same rule short, same rule long. And then you got to limit the number of iterations you're doing. So if you're doing a moving average, you don't do 2 to 500 of every single bar, right? 2, 3, 4, 5. You do a lot less, and actually less than 1,000, less than 100 is even better. So it's a very slight optimization. And I'll tell you, this works. It's pretty powerful, and it definitely can help you. So you limit what you're doing. And if you ever get the feeling, the kind of feeling in the back of your head, the kind of gnawing feeling, ooh, maybe I've optimized too much, I guarantee you already have. You've already gone too far, and you got to stop. Because when you start thinking you might have done it, you're already way too far. So, okay, that's the first one. So you got to optimize. You can optimize. I'm not saying don't do it. You just got to be intelligent about it. And to be intelligent, you got to limit how you're doing it. Okay? Does that make sense? If you have questions about it, and I see people typing in questions, if you have questions about it, I definitely will get to it at the very end. It should be pretty straightforward, but I'll be glad to stick around and answer questions. Next one is good, but what does that mean? Okay, so here you go. You start out, you start playing around with your strategy, and you start with the graph on the left. Okay, there's my first equity curve, and I'm going to add some filters. I'm going to add a rule. Oh, maybe I'll do this, that, add some variables, all kinds of stuff, and you end up with the one on the right. How many of you have done something like this? And here's our next poll. So how many of you started with a strategy that just was mediocre, but by the time you were done adjusting rules, adding filters, whatever, you made it a great looking back test? Wow, I was not expecting this answer. So I like doing these polls because it's the only way I get to talk to you. It's like when I do live things, you can actually see people, and you can see them reacting, or in my case, usually falling asleep. But I'm working on that, trying not to get people to fall asleep. All right, so let's close that. 74% of you said you've done this multiple times. Okay. This is a big mistake. You need to fix yourself from this and just stop it. Because if you start out with a strategy that kind of looks like this, if you get it to look like the one on the right, so you start out with the strategy that looks like this and end up with this one, my guess is you've done too much to it, okay? Because usually good strategies start out pretty good, and then maybe you tweak them a little bit, but this is a big problem. It's good, but it's not good because you spent too much time developing it. And what do I mean by that? Well, here's something interesting. There's a parameter I use. It's called the return to drawdown ratio, and I'll tell you how you can get it later, how I calculate it. But what I found was I looked at my strategies and student strategies, and what I found is if this ratio was below a certain value, we'll call it X, then the chances of my strategy being pretty good were pretty low, okay? So that's the red one on the left. So I had a, 28% chance of that strategy being good. But if this ratio was too good, if it was too high, okay, And so let me go back. Something like this would make that ratio too high. So a great looking back test. Well, if it's above a certain value y, well, only 35% of those pass. So again, not as good as right in the middle. And so what this is saying is you want your strategy to be good, but not too good. And, you know, if I could listen in on you guys, I'd probably hear the sounds of heads exploding, because almost nobody treats back tests this way, where, hey, I want to make a good back test, but I don't want to make a really good back test, right? You're probably thinking, what kind of idiot is Kevin to say you can't make the back test good, you know? Well, it's true. Obviously, if the back test isn't good enough, which is over here on the left, strategy's not going to be good. But if the back test is too good, your success rate goes down. And what's that telling you? It's telling you you probably developed the strategy wrong. You probably curve fit, overfit, too many rules. You know, whole host of different things. You might have gone back and thought you did out of sample data, but then you went back and retested on the same data. So no, it's not really out of sample. So that is key. Now, I see a question coming in about, well, what are those numbers? I'll get to that in a second, and it's hard. Well, you'll see the answer in a second. So, you know, what it comes down to is this kind of Goldilocks approach. The left, your strategy's too cold. The right, your strategy's too hot. In the middle, your strategy is just right. And that's what you got to aim for. So, and like I said, this is from evaluating hundreds of not only my strategies, but student strategies. So this is pretty accurate. It seems to hold up. You know, the first time I think I mentioned it to my students was back in 2017. I said, hey, look, I think you want to do this. And then in 2019, earlier this year, I went back and looked at it again with all the data since that point. And you know what? It still held that if the strategy was too good, it probably wasn't going to pass. So keep that in mind. Now, how do you do this? I'll tell you how I do it. I have a Monte Carlo spreadsheet that calculates something called return to drawdown ratio. So let's just say you had a $2 return and a $1 drawdown to get that return. That ratio would then be 2 to 1. Okay, that's just one way to think about it. It's actually, of all these numbers, it's in the red box. And all you do with the spreadsheet is you input your trades and then put some parameters for your starting capital, hit calculate, does the rest for you. So in my own trading, I have this X1 and X2. So I only accept strategies with the return to drawdown greater than X1 and less than X2. And those numbers I share with my students, and I only share it with them because I think it's important how they build the strategy. So I think those numbers are partly an outcome of how you develop the strategy. So if you're looking to do this, first go download my spreadsheet. If you go to my resource talking a little too fast, resource page of my website, a little ways down, you'll see Monte Carlo spreadsheet. Then I would do is find those values for yourself. Analyze a bunch of your strategies. You know, chances are you've been developing them for a while. Look at the ones that have failed and look at the ones that have passed and see if you can figure out X1 and X2 for you. Now, I use return to drawdown because I found that it works, and then I've proven it's worked over years and years. But maybe a different metric will work best for your strategy. So I can't tell you values to use because I don't know how you're developing your strategies, and that becomes an important part of this, is I think the values depend, in fact, on how you develop it. Okay? Of course, you don't have to do all this if you attend my workshop, which has won third-party awards. It's highly ranked. Trustpilot's a third-party website. It's got perfect reviews there. And then there's a website, tradingschools.org. Anything you're looking to buy, go check out that website. I'm the only person who's ever gotten 2 5-star reviews from them. Usually they give 1-star reviews. So, this workshop's kind of at a different level than everything out there. So you might want to consider it. And I've also taught 6 trading contest trophy winners, which is pretty cool. They didn't all attend this workshop, but they all attended things that I taught that were related to this. So that's pretty powerful. So I'm not saying you have to go out and win a trading contest, but I'm saying people have used my material to do it just like I did. Okay, so number 1 was intelligent optimization. Number 2 was good, but don't make it too good. And you can measure that, but on the development side, you just make sure you don't try to create a great back test. Third one is called baby it. Okay? Here's what most people do when they develop a strategy. They build a strategy, they back test and optimize it, they trade it live, they lose money, and then they go back to the start and build another strategy. So I'm curious if this is your process. So let's launch this poll. Is this how you build a strategy? Or, is this kind of how you get your results? Okay, so it looks like roughly 60-40. So 60% of you don't do it, and that's awesome. Hopefully it's partly because you've been listening to some of my other webinars and you understand that this is not a real good way to go. But in general, most people I talk to tend to do this kind of thing. Why? Well, the trading software kind of encourages it, right? You build a strategy and then you stick it on a chart, and then of course you open it up, the properties for the strategy, and optimizing is real easy. They go and optimize it up until yesterday, trade it live, and then it falls apart. I mean, that's usually what people do. What we do with the Strategy Factory, we still build strategies, still back test, but then we wait. We don't trade a strategy right away. We wait 6 to 9 months, and then we trade it live only if it's good. So it's got to prove itself in real time. And then we go and build more. Now, it's not to say, I got rid of the lose money box, but it doesn't mean we never lose money. Far from it, we still lose, not all the time, and I don't think as frequently as what most people do, but it's not perfect, but it does skew the probabilities kind of in your favor. It's a good technique. And then we go and build more, and then you start getting into diversification. But each one you do this waiting 6 to 9 months, which is called incubation. It's babying it. How good is incubation? Oh, I'm sorry. Thank you for telling me my screen wasn't shared. Let's go back. So this is what we do. Build the strategy, backtest it, wait 6 to 9 months, trade it live if it's good, and then build more. Okay, and then go back to the beginning. Okay. And it's this waiting 6 to 9 months that is really the key. And what I've found, and what people I've worked with have found, is that tracking a strategy in real time, doing this incubation, eliminates the quote-unquote dogs, the bad strategies, before you commit real money to them. Is it easy to do? No, because it's the first time I did it, I still remember I created a system. I so badly wanted to trade it. Oh man, I'm gonna not trade it and lose, give up all this money. I want to trade it, but I said I gotta wait 6 months and see how the strategy does in real time. Because you know what? There's no cheating in real time. Because there's no way you could have developed a system knowing what the next 6 months were, because you didn't know them. So if you look at strategy efficiency, so this would be just how well it does. If it's 0, it's just a break-even strategy. If you look at the strategies that don't pass, they're pretty bad. They usually lose money. Okay, well, that makes sense. That's after 6 months. And the ones that pass usually do pretty well. Okay, now you could say, well, how does that help me? Well, think about if you were trading all of them. Okay, well, then your results would be somewhere between these 2 points. It would be a little positive, it looks like, just averaging it. But by eliminating all these bad ones, now you're left with ones that have proven themselves in real time. And that's big. That's big. And not every strategy will do that. Most, I want to say 50% will probably fail real time. And it could be because you did something wrong in testing, could be the market changed, could be a whole host of things. But the important point is you want a strategy to prove itself with unseen data before you commit money to it. Doing it saves you money. And in fact, I polled my students at one point, and 88% of them said this step, this incubation, has saved them money. That's pretty powerful to know that just doing one thing to what you're doing with your trading, this can really improve your performance because you're eliminating a lot of weak strategies or a lot of misdeveloped strategies, however you want to look at it, and you're keeping the strong ones. And that's pretty cool. So I'm going to show you how I do it. I'm going to show you how you can do it. Okay, so first I calculate my average monthly profit, and I use a walk forward back test. So I calculate that average right when I'm done developing the system. And then I do the real-time performance for 6 to 9 months, and I calculate that average profit. I divide B divided by A, and if it's greater than double Y, then I go live with real money, okay? And of course, I'm giving the traders I work with my recommended value for this. And again, this is going to be different depending on how you develop a system, because you can see, if I can highlight it, note the way I'm doing it. I'm using a walk forward back test. If you don't use walk forward back test, this number is going to be different. If you don't do any kind of out of sample testing, this number will be different. So it depends on how you do it. I can just show you this is how I do it, and this seems to work. So what you could do, you could still calculate this, and if you do the walk forward, hey, that's great, but let's just say you don't, so I'll just cross that out. You calculate the performance, and then you would calculate your own factor. And how do you know what the factor is going to be? Well, again, you look at strategies you've developed and how they've worked out, and that can help you determine what's good and what's bad. And then you can come up with your own factor. So yeah, that would take a little work if you're going to do it on your own, but that's what I did. Okay. And all of these, this is what I did. And I had to do it based on my own strategies. Now I do it based on my strategies, and I also confirm it with student strategies. So you would have to do it on your own, but then again, it's custom tailored for the way you develop systems, which is the important part. There is no one size fits all that, hey, whatever number I use, you should use, even though we're doing things totally different. I don't think that would be accurate. So that's how I do it. That's how you can do it. The key is really doing it. That's big. Okay. And the fourth secret is called entry E. And so what does that mean? This is a new one that I actually just rolled out to my Strategy Factory students, traders, a week or two ago. I do a lot of research just ongoing of trying to develop systems that work better in real time. I mean, that's everybody's goal, right? So I came across this particular point, and it turns out it's really pretty good. So before I ask that, how many of you have ever felt like doing this to pick your trades? Flipping a coin. How many of you feel like that's something you do, should do, or hey, whatever I'm doing can't be worse than this? And we seem to be pretty well split. I'll close it in a second here and just see if anyone else is voting. Yeah, roughly about half of you have considered flipping a coin. And I've done it too. I mean, sometimes you feel like, man, I should just flip a coin. I can't be any worse than what I'm doing, right? And what does that come down to? It comes down to that question up at the top. Do you have an edge? I think we'd all agree, if you're flipping a coin, you have no edge, right? It's random. Agreed? Everybody agrees with that. Okay. So if it's that easy, just flipping a coin, think about if you get an edge, how much better that would be, okay? Because when it's no better than a coin flip, your chances of success are way down. And I know a number of years ago, Van Tharp or somebody else ran a test that showed, hey, if you had the right exit, you could make money with a random entry. And we've probably all run those tests or thought about that. Hey, I'll just control the exits. And okay, well, I don't know. I wouldn't want to put real money behind a random entry system. But the point there, I think, was really that exits are important. And I'm not going to try to shy away from that. But I'm saying, hey, let's start with entries that are better than random, right? Because otherwise, just flip a coin and work on your exits. Don't worry about entries. And you probably say, well, you're crazy. You're crazy if you think that. Well, that's why you work on your entries. So you need an entry that's better than random. And you need to know it overcomes slippage and commission. Because I'll tell you what, there's a lot of entries out there that are better than random, but they don't overcome slippage and commission. The edge of them is so small that you really can't benefit from it, okay? And that's definitely true. Okay, so the way I'm doing this, I'm using something called the E ratio, and it was popularized, I should say popularized by Dave Bergstrom. If you've heard of max favorable excursion, max adverse excursion, that's what it uses. It figures out during a trade, it calculates what was your maximum profit at any point during the trade, and what was your maximum loss during any point during the trade. What's interesting is Tradestation calculates in their reports max position profit, max position loss, and actually, I think there's an incorrectness in the way they're calculating it. So I've corrected for it. I've created code that will do it correctly and calculate this ratio. And one way to look at it is if your ratio is below 1, you have no edge. And if it's above 1, you have some edge, right? And you've got to do it with slippage and commission, because if you have an edge before slippage and commission, who cares? If that ratio goes under 1 with slippage and commission, that's what really matters, right? Because slippage and commission are real. A lot of people like to pretend that it's not, and that they'll find some magic broker that will prevent that, but it doesn't happen. So I calculate this for just my entry rules. So I scrub out the exits out of my strategy, and I just put the entries in and I exit after 1 to 20 bars. And you can see this ratio starts out low because of slippage and commission are really playing a bigger role here. And then it eventually comes across. Now this particular strategy, there's no edge here, right? Because it's under 1. So why, if you knew this, why would you actually trade this? Okay. Well, maybe you say, I got great exits. Okay, I understand that, but realize what you're doing is you're putting yourself in an unfavorable spot. So one way to think about it is you want to go from New York to Los Angeles, and you're going to go via train. Some people do that, okay? And you're in LA, and the train, you notice the train, well, no, let's say you're in New York, because I think can you go east from New York? All right, it's a bad example. I'm sorry, I'm trying to think of it offhand. Let's say you're going New York to Chicago. How's that? And you're in Chicago, and you want to get on a train going to New York, and you see a train going west, which is opposite of New York. Are you going to hop on that in the hopes it turns around and starts going to New York? Or are you going to hop on a train that's already going east? That's what you're going to do. You're going to hop on a train going east. Same thing here. Why would you want to trade a system where your entry doesn't really get you going in the right direction? That's what it's all about. So it's pretty cool. So the way I do it, I calculate this based on a bunch of optimization runs. It's a pretty rigid process. And I like I said, I created code that Tradestation spits out. I copy it to Excel, and then I've got a single number over here. And as long as it's greater than a certain value, then I consider it good. Okay. So this one's above 1, so that's good. Is it above my threshold? Well, again, that's something that's dependent on how you're building strategies and how you're measuring this E ratio, what you're assuming for slippage and commissions. Because if you're off on slippage and commissions, for example, you could actually overestimate this ratio and think you have an edge. Then you go live trading and whoops, you don't. So you got to watch out for that. But I've set it up pretty easy. The question is, does it work? You could do something similar, definitely. Does it work? Here's an example. So that E ratio, if it's less than double Z, I went and looked at a whole bunch of strategies. The average strategy was now minus $112 average profit. But on ones with the ratio greater than Z, it went to a huge profit. So look at the difference in this ratio. And this wasn't curve fit or anything like that. It's just taking a strategy and stripping out the exits, looking at what its entry did and how it works over 1 to 20 bars, and then calculating that ratio and comparing the performance with the exits back in to without. And it's a huge difference. So this E ratio can be really, really powerful. I was just emailing somebody, a student, before this class started, and I was like, this is probably one of the best things that I've come across, and I've researched this over a number of years. I've looked at so many different parameters to predict future performance. This really seems to work pretty well. High ratio, definitely better. Again, remember earlier I said good, but where it could be too good. this probably could happen with this. I haven't really investigated, but you probably could have too good of a ratio, which would suggest you just curve fit or just hand selected the rules too tightly. So, but in general, the higher ones definitely better performance. So, like I said, you can do it. You can calculate your E ratios. You can look at your data for your winning and losing systems. So look at what I've done. You know, the first powerful technique I gave you, you could do pretty much regardless of how you develop systems. Those are all like general good things with the iterations and number of rules, number of variables. But these other ones, these calculations, you really got to do it and evaluate it with your own systems if you have a different technique than to develop systems than what I do. Or of course you can use what I do and I give you those numbers. But your threshold would probably be different than mine. So I don't want to, it's not that I'm not giving you something by not giving you my numbers, it's your numbers could really be different. And I'd hate for you to throw away good systems because you say, oh, Kevin's ratio, it fails. Well, maybe yours is different. But by doing this, you maximize your winning strategies, you minimize your losing strategies because you just say, I'm not going to trade them. One thing, hey, you take that incubation and you take this E ratio, combine them, you get even better. It's pretty cool. So just to kind of sum up, we got INOPT, intelligent optimization. Generally, you want less than 1,000 iterations for less inputs. Less is better. This good but, you want to return the drawdown ratio or whatever metric you use to be above a certain amount, but not too good, because if it's too good, it's probably curve fit. That's what you got to keep in mind. So good enough to maybe be real, but not too good to suggest it was developed poorly. You want to baby it. You want to watch that performance live. It is really hard to do. Like I said, most people can't do it. They just don't have the discipline to set strategies aside. There are some shortcuts to it. I'm not even going to mention what those are here because people will misuse them. I don't even teach my strategy factory students those right off the bat. I let them go for a while doing this because this is a good test. So the 6 to 9 month performance efficiency, that's a good one. And then this E ratio greater than a certain value. Tell you what, you put all these together and you do all these, and you can do all these, by the way. They're not like one or the other. Oh, I can't do this. You can do all of them, and you can really improve the strategies you're creating, definitely. So, like I said, those parameters are going to be different values for you, and it depends on how you do strategies. And, if you were one of my traders, I would give you all those values so you'd get off to a great start. Of course, then you'd also be learning how to develop strategies in the best way possible. But you can definitely do this on your own. So if you have a good development process. Now, if you don't, I don't know. I don't know if this will really get you over the hump. If you do a lot of things wrong when you're developing systems, there's not a lot to do that can save you. Okay. So like I said, my solution is a strategy factory. I can teach all these things. I support you. I don't have a team of support people. It's me. You email, I respond. Some people have sent close to 1,000 emails when they were students. And I've responded to all the ones that needed to be responded to, which were close to 1,000, because usually people just don't email me and say, hey, how you doing today? They ask questions. So I answer. And if you don't know easy language for Tradestation, that's what we all use in the Strategy Factory Club. I now have an add-on that will help you learn easy language programming. And I've also got an outside expert to come in and kind of help me with some of the support for that. Pretty cool. So I mentioned 300 strategies before. This graphic's a little outdated. It is now 300. So let me just scribble that in. and you'll never notice that it was changed. And it is hard writing on with a mouse. Okay, so anyways, if your current strategy development is just killing you, think about this course. Go to my website, kjtradingsystems.com, click on strategy workshop at the top. You'll learn all about it, what it's got, what we're learning, and if you want more information, I'd be more than happy to talk to you via Skype. Just let me know. Send me an email. I'll put you in touch with students. A lot of good stuff there. Okay, let's erase that. Here's just some of the strategies students have created, and you know what? You see good looking strategies, but they're not great. They're not perfect, and that's good. That's what you want. Usually the better things look, 9 times out of 10, it's going to be bad. I think in the last webinar, I tricked everybody by showing a system that almost never lost that I had, and I said, is this real? And everybody's like, oh, that's fake. And it actually was real, but there was a catch to it, which I explained in that webinar. But these are good systems. They're not necessarily great, but that's kind of what you want. The greater ones tend to not work going forward because usually they weren't developed right. Okay, so with that, I'm going to do questions in a second if you're listening live, so hang around. But thanks for joining me today. And even though this isn't Ibiza, this is a picture from Ohio. So thanks for attending.